So the contents of this webinar were developed under Grant H421 F2 40198 from the US Department of Education, the department. The department does not mandate or prescribe practices, models, or other activities described or discussed in this document. The contents of this webinar may contain examples of, adaptations of, and links to resources created and maintained by another public or private organisation. The department does not control or guarantee the accuracy, relevance, timeliness, or completeness of this outside information. The content of this webinar does not necessarily represent the policy of the department. This publication is not intended to represent the views or policy or be an endorsement of any views expressed or materials provided by any federal agency under Edgar 75.620. And so welcome to our bookkeeping and accounting essentials for startups. It gives me great pleasure to introduce yourself, Catherine Wright, from Right Way Tax Solutions. We have worked with Catherine on a number of occasions, and she is just a font of all knowledge when it comes to all things tax, particularly for small business owners. So with that, Catherine, I'm going to hand it over to you.
Hello, everyone. I am so honored to be presenting for you yet again. I really enjoy sharing my knowledge with new entrepreneurs and even experienced ones. So we do have a lot to cover today, and I'm going to just go right ahead and get started. So good afternoon again. My name is Catherine Wright, and I am an enrolled agent and founder of Right Way Tax Solutions in Baltimore, Maryland. Today, I'm going to be guiding you through this workshop called Bookkeeping and Accounting Essentials for Startups. So whether you're just launching your business or you're just looking to solidify your foundation, this is going to be a great session for you today. So let's start with our learning objectives. Today, we're going to be able to distinguish the difference between a sole proprietor and an LLC, understand the importance of a business bank account, identify tax responsibilities for sole proprietors and single member LLCs, understand how to set up a basic accounting system, and lastly, we're going to be able to recognize business income, expenses, cost of goods sold, and net profits. So let's start with the sole proprietor. Exactly who is a sole proprietor? A sole proprietor is a single business owner. With a sole proprietor, they do not need an employer identification number, which we will also be calling an EIN. Now, the downside to just being a sole proprietor is that your personal assets are at risk, meaning that if someone was to bring a suit or some type of litigation against your business, then your personal assets could be at risk of being affected because of that. As a sole proprietor, you're also responsible for paying self-employment tax, which we're going to talk about, and also making estimated tax payments, which we will also talk about today. A sole proprietorship is actually the simplest form of doing business, but it may not actually be the safest form if you're trying to protect your personal assets. So let's discuss an LLC. An LLC, or as we call it, a limited liability company, not a corporation, because sometimes people get it confused. An LLC is not a corporation. It's a formal business structure that you must register with the state that you plan to do business in. This makes your business a legally recognized entity separate from you personally. So each state is going to have its own registration process, their own fees, and their own rules. So always check with your state or with a business attorney to find out how you need to properly set up your LLC with the state. So unlike sole proprietors, an LLC is required to have an employer identification number. even if you do not have employees. This EIN becomes your business's identifier. So look at it as if it's like a social security number, but it's for your business. So one of the most important features of an LLC is the liability protection that I was previously speaking about. That means if your business is sued or it faces some type of financial trouble, your personal assets like your home, your bank account, your personal bank account, they are going to be generally protected. This is a big reason why people choose an LLC over operating as a sole proprietorship. If you are the only owner of your LLC, the IRS will treat you the same way that they treat a sole proprietor for tax purposes. And that is because LLCs are disregarded entities when it comes to tax. However, even though you're being treated as a sole proprietor, you will still get that legal separation and liability protection because you are an LLC. If your LLC has more than one member, then by default, the IRS is going to treat that LLC as a partnership. So lastly, LLCs are very flexible because you can elect for tax purposes only to be taxed as an S corporation or a C corporation by filing specific forms with the IRS. So this presentation, we will not be discussing how to do that, but if this is something you're interested in knowing about, make an appointment with your tax advisor and have them give you more information on whether or not this is a good option for you. So I talked a little bit about employee identification numbers. Now I want to make sure that you understand how to apply for your employer identification number. So if you're forming an LLC, your first step is that you're going to register your business with your state or your Secretary of State office. This step is going to create the legal framework for your company to actually exist. And it's also going to produce your registration approvals or your articles of organizations. Now, if you are a sole proprietor, you may not be required to register your business with the state, but if you're an LLC, you are required. After you have registered your business and your application has been approved, the next step is you're going to go to the official IRS website, www.irs.gov/EIN. And that's where you're going to apply for your employer identification number. This process is free. It should take you less than 10 minutes to apply, and it's secure. Once you have completed your application, your employee identification number is going to be given to you immediately. So you'll be able to print it off, print it. You can download and save it. And then within 7 to 10 business days, you will receive the official notice in the mail with your business name and the employer identification number that has been assigned to you. And with this, you can use your employer identification number to open a business bank account. And we'll be talking about this also. So let's talk about business bank accounts. The next slide. One of the most important habits that you can develop early is to never mix your personal spending with your business and income and expenses, your business expenses and your personal expenses. This is what we call commingling. And commingling creates confusion. It makes bookkeeping a nightmare, and it even can put your legal protection at risk, especially if you are an LLC. So use your business bank account strictly for business purchases and deposits. If you are an LLC, even with just one member, you are required to maintain a separate bank account. This just isn't good practice. It's part of what keeps your business legally separate from you personally. If you don't keep your personal and business transactions separate and something goes wrong, a court could do what they call pierce the corporate veil, which basically would mean your personal assets could be at risk if someone was to litigate against your business. When you open your business bank account, the bank is going to check that your business is in good standing. So that normally means that you have completed all your registration steps, you've paid any necessary state filing fees, and that you submitted any forms like annual reports. If your status is not in good standing and you have not yet opened your bank account, then I strongly suggest that you get your business in good standing before you go to the bank to save yourself some time. Um, and I will also tell you this, sometimes banks do a periodic check to make sure that their business accounts, that their businesses are in good standing. And if they find that your business is not in good standing, the bank can actually freeze your bank account and you cannot use it at all until you get the business back in good standing with the state. Now, most banks, they're going to ask you for your employee identification number. They're going to ask you for your articles of organizations. They may even ask you for a business license in order to open up your bank account. So what I suggest that you do is if you know you're going to open up a business account, contact the bank in advance. Find out what you need to bring with you in order to open your business bank account. Now, I know we talked about employer identification numbers, and I want to just circle back to that. You can also get a employer identification number if you're not required to have one, if you are a sole proprietor. And that's important because it protects your privacy. As a business owner, sometimes you're going to have to fill out forms, you're going to have to issue 1099s to people, and you don't want your personal social security number just floating around the world, you know. So you can still obtain an EIN number by going to the IRS website and following those instructions so that you have something to protect yourself. And also, if as you scale and as you grow your business, you may need to hire employees. And if you do that, you already have your number. You don't have to go back and start this whole process of trying to apply for your number. So having an employer identification number is going to be needed for the bank account if you want a business bank account, and it also will protect you even if you're not required to have a business bank account. So treat your business bank account like your business financial home. You want to keep it clean. You want to keep it separate from your personal expenses and income, and you want to keep it organized. This is going to help you stay compliant. It's going to help you look professional, and it's going to simplify everything from taxes to loan applications to grant applications or whatever business you're trying to carry out. Okay, next slide. So let's talk about the importance, and you're going to hear me repeat a lot about commingling your funds, because if you don't learn anything from this workshop today, I really want you to understand how important it is not to commingle. So having a business bank account, it assists you with bookkeeping with accuracy and efficiency. It allows you to clearly see what's coming in and what's going out without having to sort through your personal grocery bills or Netflix subscriptions or whatever it is you may be paying personal out of the account. When it comes to reconciling your books, preparing your taxes, or applying for a grant or a loan, everything is organized and ready to go. Second thing, again, it prevents confusing personal transactions from your business transactions. Mixing your personal and business expenses can lead to some real problems, both legally and financially. So let's say that you buy gas for your personal car, but you also use it for business deliveries. If you use one card for everything, personal and business, you won't have clarity on how to categorize the expense. So keeping your business purchases confined to a separate business account avoids this type of a mess. This next one gives your business a professional image, and that may be more of a personal choice for me, but there are some industries that look at uh, just little things as having a business bank account. So clients and vendors, they may take you more seriously when your checks, your invoices, and payments come from a business account. It shows that you're running a legitimate operation, not saying that you're not running one as a sole proprietorship, but sometimes, depending on your industry, some people can get a little judgmental. So some platforms like payment processors, online marketplaces, they may even require that you have a business bank account in order to set up for you to receive your payments and deposits. If your business is registered as an LLC, maintaining a business bank account properly protects your personal assets from litigation. Now, this is a huge one. If you formed an LLC to protect yourself legally, that protection only holds if you maintain a separation between yourself and your business. Using a business bank account and not commingling funds shows that your business is truly operating as a separate legal entity. If you ever face a lawsuit, that separation, keeping those things separate, is going to help preserve your personal assets. And they'll be protected if someone was to litigate against your business. So even beyond just categorizing and being organized, a business bank account is going to be the pillar of your financial infrastructure. It's going to help you track your expenses. It's going to build your credibility. And if you are an LLC, it's going to preserve your legal shield. So this is not just a formality, it is a foundational tool. Okay, next slide. So now we're going to talk about tax responsibilities, and these are some of the taxes that we're going to be speaking about. We're going to talk about estimated tax payments, self-employment tax. We're not going to talk about sales tax, but what I will tell you is that if you have not already done so, you need to contact your state and find out whether or not the services or the products that you're selling are subject to a sales tax. And if it is, then you're going to need to apply for your sales tax license. So if you haven't done that, check with your state. And then finally, we'll briefly discuss the Form 1040, the Schedule C, the Schedule SE, and that's actually a typo for the last one. That should be a Form 8995. So first, let's talk about estimated tax payments and what they are. Estimated tax payments are just what they sound like. You're estimating and you're prepaying your taxes throughout the year. Since you don't have an employer withholding taxes from your paycheck, you have to do it yourself. So these payments are going to cover not only your income tax, which we all pay, but it's also going to cover your self-employment tax, which we will be discussing later. And if you have a state income tax, you may have to make estimated tax payments for your state income tax. Estimated tax payments can be figured on IRS Form 1040-ES. That form includes a worksheet that can help you calculate your tax liability. And that's going to include your income tax liability as well as your self-employment tax liability. Now, the form sometimes can be a little difficult, so if it's helpful to you, please make an appointment with your tax professional and help them figure out your estimated tax payments. Estimated tax payments are required for sole proprietors and single member LLCs. So whether you're a sole proprietor or a single member LLC, because remember, they're taxed the same way, the requirement is the same. If you expect to owe at least $1,000 in tax for the year, you're going to be required to make these estimated tax payments. It's not optional. And again, this includes your self-employment tax and your income tax. Now, the self-employment tax, especially if you're a new business, it throws you off guard because you did not know about this and you're paying these extra taxes. So it's best to make sure that you're planning. Your estimated tax payments are due quarterly. There are 4 due dates. The IRS sets the due dates as April the 15th, June the 15th, September the 15th, and January 15th of the following year. Penalties may apply if estimated taxes are not timely made or not made at all, and they were required to be made. The IRS does not want to wait until the end of the year to collect taxes. We are on what you call a pay-as-you-go tax system. If you don't make your quarterly payments, or if you underpay your payments, you can be hit with underpayment penalties as well as estimated tax penalties. So even if you pay the full amount with your tax return, you still can be given an estimated tax payment penalty because you owed more than $1,000 and you did not pay enough towards your estimated tax payments. So paying on time and paying in the right amount is important. The bottom line, if you're running a business, estimated tax payments are going to be a part of your financial rhythm. Set your calendar reminders, work with a tax professional if needed, and use the 1040ES worksheet to stay ahead of those deadlines. You can make your payments by setting up an irs.gov account, and you can make them right online, or you can pay with a credit card. And you can also visit your website, your state website, if you have an income tax, to see how you can, a state income tax, to see how you can pay your state estimated tax payment. So I've been talking a lot about self-employment tax, so now I'm going to give you a lot of information about self-employment tax that will explain exactly what it is. So self-employment tax are contributions that you make to Social Security and Medicare based on your business profits of $400 or more. And we'll be talking about profits later. Self-employment tax is just like a payroll tax for W-2 employees. The difference is you pay the full amount of it yourself because you don't have an employer to help you with those payments. If your net profit from your business is $400 or more in a year, you will be required to pay a self-employment tax on that income, in addition to the income tax we already have to pay. Your self-employment tax is figured on Form 1040ES, but it's going to be reported on Form Schedule SE, and we'll talk about that form later. Now, the IRS does allow a subtraction of 1/2 of your self-employment tax from your total income, which could lower your income tax. It will not reduce your self-employment tax, but it will reduce your taxable income. So it may reduce the income tax portion that we have to pay, that you have to pay when you file your tax return. Your self-employment tax is computed at 15.3% of the net profits from your business. So for example, if your net profit from your business was $10,000, and hopefully my math is right, your self-employment tax would be around $1,530. That $1,530 is going to be in addition to any income tax you may have to pay. So that's another reason why it is crucial that you pay your estimated tax payments. Self-employment tax is one of the biggest tax responsibilities that a small business owner that is especially a sole proprietor or a single member LLC, they're going to face. It's crucial to plan for it. If you make a profit, even a small one, make sure that it's part of your estimated tax payment. And again, if you need help, meet with a tax professional. so that they can help you figure out whether or not you should be making these estimated tax payments. One question that I do get from time to time, which I think is a very interesting question, but it's a valid question. Sometimes people are experiencing losses, so they want to know, can you mail a check into Social Security so that you can have something recorded for Social Security and Medicare? And the answer is no. You cannot make voluntary payments to Social Security. It's just going to be based off of whether or not you have profits of $400 or more. So here are the tax forms that you'll be filing with your tax returns. Of course, we're going to have our main tax return, the Form 1040. That's the one every individual in the United States files. It's going to summarize your income, your deductions, your credits, and your tax liabilities. For business owners, this is where everything is going to come together, including what you report for your business activities. So your business activities are going to be reported on Schedule C. And Schedule C is the form where you're going to report your business income and expenses. This form is going to be attached to your Form 1040. You're going to calculate your gross income, deduct all of your ordinary and necessary business expenses, which we're going to talk about, and determine your net profit or loss. Then that profit or loss will flow over into your Form 1040 and will be used to calculate your self-employment tax. The next form is the Schedule SE. If your business profit is $400 or more, you're going to file a Schedule SE with your 1040 form. This form calculates your self-employment tax, again, your contributions to your Social Security and Medicare. So that will be added to your tax liability. So you will see a line on your tax return. After we end the webinar, you can pull your last year's taxes. You'll see a line for your income tax, and then you'll see a line that says other taxes that will be tied to, I believe, Schedule 1. And that's where you can see the breakdown of what you're paying for income tax and what you're paying for your self-employment tax on your business. And then lastly, we have a Form 8995. And if you're eligible, and we're not going to get into all the rules of this form, but I just want you to be aware that it's out there. The Form 8995 will allow certain business owners to take a qualified business income deduction. And that's what we call a QBI deduction of up to 20% of your profit. So in summary, your tax return as a business owner, it's going to include several layers, as you can see. You're going to have your 1040, your Schedule C, your Schedule SE for your self-employment tax, and possibly the Form 8995. So keeping good records all year long is going to make these forms easier to complete and make sure that they're accurate. So now we've talked about opening your bank account, estimated tax payments, and some responsibilities that you have as a sole proprietor or a single member LLC. So now we need to talk about knowing your numbers. Now that we've walked through how your business is structured and what your tax responsibilities look like, it's time to talk about something that will make or break your success, your numbers. Too many business owners run their businesses based on what's in their bank account. Big mistake. Rather than understanding what your financials are actually telling you. So I'm hoping you'll get a better understanding of how to evaluate your financial statements. When you base your business on what's actually in your bank account, that approach can lead to stress, poor business decisions, and sometimes even tax trouble. So when I say know your numbers, I'm talking about being able to clearly identify your total sales, what it cost you to produce or buy any products that you sell, also called cost of goods sold, your business expenses, and ultimately your net profit, which is the number you're going to be taxed on, and that's the money that you actually get to keep. So knowing your numbers it doesn't mean you need to become an accountant. It just means that you need to stay aware and engage with what's going on financially in your business. And that's what this next section is going to help you to do. So for this section, I thought it would be a good idea just to have a case study to make this all a little bit more relatable. So I want you to meet Joe. Joe owns a t-shirt business called Jay's T-Shirts LLC. He launched his business in 2024. He purchases his shirts wholesale and he sells to the public at various events held in his hometown. Joe doesn't have any idea how to manage his finances, and he really needs our help. So let's talk about the importance of bookkeeping and accounting. And I know this is not a favorite subject of many business owners, but it's a necessary aspect of your business that you must stay on track, on top of. So track your business income and expenses. Tracking your income and expenses allows you to see what's going in, what's going out. It's essential to understand your cash flow and to keep your business afloat. It helps with generating correct financial statements for tax purposes, business loans, grants, and whatever type of business transaction you may need to provide financials for. So, accurate books are going to be the backbone of trustworthy financial statements. These are necessary when you're filing your taxes and applying for funding. And I have seen it where the financial statements and the bookkeeping were not accurate, so people were not approved for loans, especially when they had loans available during the COVID time. A lot of businesses, because their financials were not in order or they were inaccurate, they did not qualify for some of the assistance that other businesses received. Um, Bookkeeping and accounting also assist you with making important business decisions. When you know your numbers are clear, you can confidently make decisions. Like if you need to invest in new equipment, can you now afford to hire new staff? Do you need to scale some of your services? Because one service may not be bringing in as much income as another service. Do you need to reevaluate your expenses? It helps with your decision making because you know what your numbers are. So sometimes people want to know, well, who can I hire to help me with my taxes, with my bookkeeping? So here are just the normal accounting and tax professionals that you may want to hire. You have your certified public accountants, your CPAs. They're licensed professionals who can handle complex accounting, audits, and strategic tax planning. You have your enrolled agents, such as myself. We're licensed by the federal government under the Internal Revenue Service, and we are authorized to represent you at all administrative levels before the IRS and in most states. Then you have your accountants. They're not licensed, but they have the educational credits needed to help with bookkeeping and accounting. They just did not take the test to become a CPA. You have your bookkeepers. Your bookkeepers, they handle your day-to-day tracking of your income and expenses and bank reconciliations. Bookkeepers are a good people to have on your team, especially if you cannot afford the services of a CPA or an accountant. And then finally, you have your tax preparers, and they're mostly focused on filing accurate tax returns for you. Some states require that they be licensed. Some states don't require that they're licensed. And then they also have an option to get a certification with the IRS. So these are your accounting and your tax professionals. So you also have your cloud-based accounting system. So let's talk about accounting systems. You have your cloud-based, QuickBooks Online, Wave Accounting, Found.com, Zoho Books. If you Google, you'll find a ton of them, and you may also find uh, software that may be industry specific for which you're working in. The cloud-based accounting systems, they often integrate with your bank accounts and other apps that you may use. Then you have your desktop accounting systems. And these systems are good for those who prefer offline access because they don't want their information in the cloud. But the problem with that is a lot of the desktop versions are now switching to cloud based, and you don't get real time syncing like you would with a cloud based system. But desktop systems are fine. And then you have the old trusted one that a lot of people use, and that's spreadsheets. Spreadsheets are simple, but they are prone to human error if the inputs are not put in correctly. And also, if you need to get some on demand reports, that may be a little challenging. But spreadsheets are also an option. And then the last option, which I totally do not recommend for any business, is what I call the shoebox method. And that's just dumping receipts into a box. It creates chaos, and it's, you can be at risk if you can't read those receipts or if you're not categorizing properly. I do suggest that you invest in a scanner, or you have some type of an app. I know QuickBooks Online, Wave Accounting, and a lot of the cloud-based software, whereas they will allow you to take a picture of your receipts so that you have them. Because with paper receipts, over time they fade, they get lost. Sometimes people throw them away. So in order to keep the integrity of the receipt in case you need it, I would suggest that you scan in any paper documents that you have for your business, not just receipts, business agreements, or whatever documents you may have for your business. So let's go back to Joe. So Joe, he has decided on the accounting system. He's going to use found.com. He chose this system because it's cloud-based and it is free. He can connect his business bank account and categorize all his transactions. So was a smart move on his part. Now, since Jay's T-Shirts LLC is a new business, he's going to hire an accountant to review his accounting system every quarter so that he stays on track and he avoids error. As a new business, sometimes you can't just jump in and hire somebody. But what I do recommend is if you're going to do your own bookkeeping and you're not knowledgeable of accounting rules, just hire a professional to come back and review your work every quarter, or if not, at least twice a year. Joe has now registered his LLC with his state, and he now has a business bank account. His LLC is important because it's critical for separating his business and personal finances, and it gives him legal protection and clean records. So we are talking a lot about bookkeeping and accounting, and now I want you to understand, how to read your statements, how they computed. And the first thing that we're going to discuss is revenue. So revenue is the total amount that your business earns from selling goods or services before deducting any expenses, any business expenses. This is going to be your top line number. This is going to let you know how much money you made in your sales. Revenue is often referred to as sales or gross income. So if you hear that, that's a lot of times what people are talking about. So it all means the same thing. It's your total earnings before any expenses. Okay, next slide. So here is an example of revenue. Joe sold 250 shirts for $20 each at a music festival. Excuse me, I'm sorry. And he collected a total of $5,000. Joe's revenue is $5,000 because that's how much he collected for his products. He hasn't deducted any expenses yet. Now, because Joe sells a product, he also needs to know his gross profit. So this section is especially going to be important to those of you who are actually selling profits, selling products, not services, but products. Because if you sell products, you also need to know your gross profit. Your gross profit is going to tell you how much you earned after you subtracted the direct cost of producing your goods. It's a key indicator for profitability. And we're going to talk about those direct costs, which we call cost of goods sold. So if you sell products, your gross profit will be your revenue, which is your gross sales, minus your cost of goods sold, and that's going to be your gross profit. So let's talk about cost of goods sold. Cost of goods sold refer to the direct costs of associated with producing or purchasing goods that a business sells during a specific period. These expenses directly tie the creation of the product to those that are sold to the customers. So they include raw materials, product purchases, and labor tied to the production, and you may have some other costs. So the formula to computing your cost of goods sold or your direct costs in relation to producing your product is your beginning inventory. We're going to talk about that. Your purchases, we're going to talk about that, plus your purchases, and then you're going to subtract out your ending inventory. So let's walk through this breakdown. So for your inventory, that's going to include all your finished and unfinished materials that you have not sold. So that you have not sold. Your raw materials, your products that are ready for sale, and any materials you use to build or manufacture your product is going to count towards your cost of goods sold. So beginning and inventory amounts are at cost, how much you paid for them. And always value your inventory based on what it cost you, not the resale value. So let's look at beginning inventory. You need to have your starting point, and it's best to have this starting point when you first open your business. So when Joe started his business in the beginning of 2024, in January, he had the following inventory. He purchased a box of 500 t-shirts that cost him $500. It was $1 per t-shirt because he buys wholesale. So his total beginning inventory is going to be $500 because that's what he paid for the shirts. Now we need to figure out what his ending inventory is. At the festival, Joe sold 250 of his t-shirts and he had 250 remaining. So his beginning inventory was $500 because that's what he purchased, and his inventory at the end was $250 because that's how much of his investment into the t-shirts he had left over. You should always start with your beginning inventory, and then at the end of each year, you should calculate your ending inventory. It's important because if you're selling products, you're going to need that when you file your tax return. Okay, next slide. So now that we know how to compute your beginning inventory and your ending inventory, there may be other costs. And you may have shipping costs to receive your inventory. That includes what you pay to get the goods delivered to you. Your packaging, if you wrap your product up in a package, any materials you use to wrap, that's also counted towards your cost of goods sold. Your cost of labor to create your product. If you paid somebody to sew, assemble, or build your product, that labor is also included in your cost of goods sold. And any other costs that you pay to get your product ready for sale. It could be storage, assembly fees, final processing costs, or anything else that's related to, getting that product ready for sale. Those are going to be your part of your cost of goods sold and you would categorize those under other costs. So let's take a look at Joe's other costs. We know that he purchased his inventory at $500, but he had other costs he had to pay. He paid $100 for a storage fee, and he also paid $300 for packaging his shirts. So his total other costs are $400. So I know we covered a lot. Hopefully this is going to bring this all home for you on how to calculate your cost of goods sold. So you're going to start with your beginning inventory. Joe's beginning inventory was $500 for the initial purchase that he made. Then you're going to add in your other purchases. He paid for the storage and he paid for the packaging. That cost him $400. And then after that, you're going to subtract out how much inventory that you have left based on how much you paid for the inventory. And in his case, he had $250 of inventory. So when you take the beginning inventory, you add in his other costs that he had to pay for the products, and then you subtract out his ending inventory. His cost of goods sold is going to be $650. And this amount shows you how much it actually cost him to sell his shirts. So as I said, we have revenue, and then if you sell products, we have your gross profit. So this is how this calculation will work to figure your gross profit if you sell products. You're going to take your revenue. Joe's revenue was $5,000. You're going to subtract out his cost of goods sold. It was $650. So his gross profit was $4,350. So that is his gross profit. The next thing we need to figure out is what were his business expenses. So business expenses, next slide, sorry. Your business expenses have to be ordinary and necessary. So the IRS defines ordinary as an expense that is common and accepted in your industry. So if you are a hairstylist, buying shampoo is an ordinary expense because it's acceptable. Necessary means that the expense is helpful and appropriate for your business. It doesn't have to be indispensable. It just has to be reasonably related to your work. So here is an example of Joe's business expenses that he had. Joe, he purchased a receipt book for $15, and he purchased a computer for $800. Both of these expenses are ordinary and they are necessary for his business, and they should be deducted as a business expense on his tax return. So Joe's allowable business expenses will be $815. So just to recap, these fit the IRS test for business deductions. They're relevant, they're useful, and they are typical for someone running a t-shirt business. These expenses, this $815 is going to be deducted from his gross profit in order to calculate his net profit, which is what he will be paying his taxes on, both income and self-employment tax. Next slide. So in order to calculate your profit, you're going to use either your revenue if you provide services, or you're going to use your gross profit if you are selling products. And then from there, you're going to subtract your allowable business expenses. That is going to give you your net profit. That's going to be the final step in your business financial story. What's actually left over after you pay all your direct costs and business expenses? That's going to be your real income. It's your tax base. Next slide. So let's look at Joe's profit. Joe, his revenue from his sales was $5,000. His cost of goods sold, which included his beginning inventory, his other costs, and then subtracting out his ending inventory, was $650. So his gross profit was $4,350. Next, he needed to deduct his business expenses. He has a receipt book. His receipt book cost him $15, and his computer cost him $800. So his total expenses were $815. So you take his gross profit, subtract out his business expenses, and his net profit, which will be used for tax purposes, was $3,535. He can use that $3,535 to reinvest in his business, to pay himself, or whatever he wants to use it for. But that is his real profit from his selling his t-shirts. So Joe is very happy. He has come a long way from having no knowledge to getting just enough knowledge to know that he is actually running a profitable and safe business. So Joe, he registered his business with the state. That legal registration gives him protection and legitimacy as a business owner. He applied for his employer identification number, which I said is like your social security number for your business, and it's required for filing your tax returns and opening bank accounts. He then opened his bank account, which is going to help him keep his finances clean, legal, and trackable. And it's one of the first things that every entrepreneur should do. He's no longer commingling his funds because he now has that business bank account. He's keeping his business and personal money separate, which is helping him to maintain his liability protection and helping him to avoid, and his tax preparer, to avoid tax headaches. He's using an accounting system. This is going to help him automate transactions, categorize spending, and generate reports on demand. Now he knows how to compute his revenue, his cost of goods sold, and his gross profit. And he understands the key formulas to evaluate his financial health. That's important. He understands how to compute his net profit, and most importantly, he can now calculate what his business really earned with that investment of $500. He can also provide his financial statements to his tax preparer, who can now file an accurate return and help him to figure his estimated tax responsibilities in the future. And it will be based on clean and current data. So here's just a checklist for you as we come into a close to the presentation. Registering your business with the state, if you're an LLC, it's going to help you start with a legal foundation. Your registration is going to offer you liability protections, and it makes your business official. Apply for your EIN number. That will be helpful. It's going to be required if you're an LLC, but you're going to need that if you're going to open a business bank account, if you're going to hire employees, and even if you're not required to have an EIN number, I suggest that you do apply for one so that your social security number will be protected. Open up a business bank account, even if you're a sole proprietor and not an LLC. If you can't open up a bank account as a sole proprietor, open up a separate checking account. Just open up something that's going to keep your personal and business transactions separate. It's essential to separate your personal and business funds. And it's key for audit protection. And not only that, just keeping everything organized. Again, I know I said it 50 times, but don't mix your business and personal finances. Commingling funds can avoid a lot of problems, including complicated tax filings, trying to get organized, and if you are LLC, liability protections. Set up an accounting system and keep the data current. Use a tool that fits your business, and I gave you a few. Now, I'm a cloud person. Everybody's not a cloud person like me. But whatever method you use, please do not use the shoebox method. Keep it updated. Keep your data updated weekly, monthly, have some type of schedule. Set an appointment with yourself to get your data current. Please do not wait to tax time to try to get these things organized. It creates too much anxiety because you're not sure if you made a profit, if you had a loss, if you're going to owe taxes. But if you stay on top of this throughout the year, then you will be, you'll make out a whole lot better. Choose an accounting and tax professional if you need help. Don't wait until you're overwhelmed. A professional can help you stay compliant, and in the long run could lead to you saving money, especially if you get audited, or suppose you need a loan. You'll have some ready financials and you'll be able to meet some key deadlines. So in summary, this is what we've learned. Sole proprietors and single member LLCs, they are treated the exact same for tax purposes. They report their income on a Schedule C, unless the LLC is electing to be treated as a corporation. Sole proprietors' personal assets are at risk. They don't have legal protections. So possibly your home, your car, or your savings could be seized if there's a lawsuit. Business bank accounts help protect legal and financial boundaries. No commingling. This is crucial for your legal protection, especially as an LLC. And it keeps your records clean and it maintains your corporate veil. Tax responsibilities include estimated tax payments and self-employment tax and possibly sales tax. As a business owner, you're responsible for paying taxes quarterly and covering both your employer and employee share of Social Security and Medicare. The importance of setting up an accounting system, whether it is a cloud software or a spreadsheet, a system keeps you organized and it reduces stress. And finally, understanding how to figure your profit and expenses. Knowing your numbers will allow you to plan, it will allow you to save, and it will allow you to grow your business with confidence. So congratulations, you made it through this presentation.